The phone with us right now is a fellow who might just put Mr. Zandy to shame. I'm talking about Stock Market Cycles editor and publisher Peter Eliades. Now, Peter, your view has always been that this market was built on a lot of froth, and you had a lot of worries. Do you still have those worries?
Well, it has not always been that, Neil, but indeed I continue to have the same worries that I had before. As you know, we haven't spoken for a while, but going back into February, we talked about the sign of the bear technical indicator that was given. And here's the interesting thing, Neil. If you look at the most broadly based of the New York Stock Exchange stocks, the New York Stock Exchange index itself, which includes every stock on the New York Stock Exchange, that is still around 3% away from its all-time highs in January. It still has not surpassed the January high. And one of the more important psychological averages, the DJIA, the Dow Jones Industrial itself, is itself around 3% away. So it's interesting what we see.
This year, right? I mean, we're looking at, this year and a lot of those highs reached in January. You could argue that if you average it all up over the many years, that the multiples still look good. Now, that's the bullish argument. You're not so sure of that, right?
Oh, I would not make that argument at all. Here's what people have to do, Neil, if they want to make this market look good in terms of valuation. They have to say, well, the earnings estimates are for 6 months or a year out or for this calendar year, and that's where they take their price-to-earnings ratios from. Those estimates are never correct. They're probably the worst numbers that you get from Wall Street is the estimates of earnings. So what you really need to do is in real time look at the prior 12 months' earnings on a trailing basis and see what the PE ratio, the price-to-earnings ratio, is from that. That, by the way, is not what I call an ideal indicator either. One of my favorite indicators is to look at the yield on the market averages. And when you see that the yield on the S&P has been below 2% on S&P stocks, you know that you are very, very overvalued, Neil.
All right, so spell it out, Peter. I mean, what do you see happening now? In other words, this has been a very long bull market here. You think it's time for it to rest. What do you envision?
Well, not only time for it to rest, but time for us to reach a major high, Neil. I can't rule out the possibility that we go to slightly higher highs in the Dow or the S&P. But if you're talking about the market's prospects over the next 5 or 10 years, I would be amazed if 10 years from now, Neil, we are above where we are now in the averages. Those are my prospects.
So you say where we are now, you think 10 years ago, we're looking back at this, similarly as we're looking back at what started in early 2009, that we'd be hard-pressed to be higher.
That's correct. That's correct. In fact, and I would be very surprised if in the meantime, within those 10 years, we don't see a decline of at least the magnitude that we saw in 07, 09, in other words, well over 50%.
What would be the catalyst, or would there be a catalyst? I know you're a technician, but what might propel that?
Well, what's going to happen theoretically is we talked about this before, Neil. Look at what the unemployment rate is. Yeah, it's a wonderful figure. It's 3% or below. But go back over the last 40 years and look at what happened when the unemployment gets that low. There's no more room for expansion, and so bad things start to happen. Those great economic numbers turn out to be bad economic numbers for the prospects of the economy.
Well, I love you to death, Peter. I so hope you're wrong, but nevertheless, it's always good chatting, my friend Peter Eliades.